Today, I wanted to talk about Tencent Holdings, which remains one of the most influential giants in the Hong Kong stock market, not just for its size, but for the sheer breadth of its business empire. Founded in 1998, Tencent has evolved from a simple messaging app into a tech behemoth with interests spanning social media, video games, cloud computing, AI, fintech, and even healthcare. Most investors know Tencent as the parent company of WeChat, which is not just a messaging platform, but an all-in-one digital ecosystem used by over 1.3 billion people for everything from chatting and shopping to paying bills and booking doctor appointments. It's basically China's version of Facebook, WhatsApp, PayPal, and Amazon rolled into one. But Tencent is not just about social media. It is the world's largest video game company by revenue. Its flagship titles like Honor of Kings and PUBG Mobile dominate global gaming charts. Plus, it owns stakes in gaming powerhouses like Riot Games, League of Legends, Epic Games, Fortnite, and Supercell, Clash of Clans. This gaming segment continues to be a cash cow for Tencent, despite recent regulatory pressures from the Chinese government aimed at curbing gaming addiction and limiting playtime for younger users. While these regulations initially caused Tencent's stock price to dip, the company has adapted by increasing its international gaming presence and diversifying its revenue streams. On the financial side, Tencent continues to post strong earnings. In its most recent quarterly report, it showed a recovery in advertising revenue, a rebound in fintech services like its WeChat Pay ecosystem, and continued strength in cloud computing. Although the cloud division hasn't yet achieved profitability, it's growing steadily and positions Tencent well in the long-term AI and enterprise software race. What's particularly interesting is that Tencent has a solid balance sheet with a large portfolio of equity investments. It owns sizable stakes in companies like JD, Com, Meituan, Pinduoduo, and even Tesla. That means when Chinese tech rebounds, Tencent gains not only from its own performance, but from the broader tech ecosystem. However, there are risks that investors need to be aware of. Regulatory uncertainty in China still casts a long shadow. The government has been known to shift policies quickly, and this affects not only Tencent's gaming business, but also its fintech and data-related operations. Another concern is growing global scrutiny of Chinese tech firms, especially in international markets like the US and Europe. Geopolitical tensions, export restrictions, and delisting fears can all weigh on investor sentiment. That said, Tencent has weathered storms before. Its size, cash flow, and diversified portfolio give it a strategic edge over smaller tech firms. The company is also aggressively buying back shares, which signals management's confidence in the stock's undervaluation. For long-term investors, Tencent represents a compelling blend of growth, innovation, and resilience. It's trading at a relatively attractive valuation compared to its historical averages, and with China's economy gradually reopening and stabilizing, Tencent could be set for a strong rebound in the next 6 to 12 months. In summary, HKG 0700 is more than just a stock. It is a proxy for the entire Chinese tech sector. If you're bullish on China's digital future, Tencent remains one of the best positioned players. But as always, stay alert to policy shifts and global market sentiment. Diversify your holdings and keep your eyes on the fundamentals. That's how smart investors navigate the Hong Kong market.
Tencent's Q1 2025 financial performance demonstrated strong momentum across revenue, profitability, and strategic investment. Total revenue reached 180 billion RMB, close to 25 billion United States dollars, up 13% year-over-year, driven by broad-based growth across gaming, marketing services, and fintech business services. Gross profit climbed 20% YoY to RMB 100.5 billion, lifting gross margin by 3 percentage points to 56%, with segment margins improving across VA's marketing and fintech services. Non-IFRS operating profit rose 18% to RMB 69.3 billion, translating into an operating margin of 39%, up from 37% a year earlier. Non-IFRS net profit attributable to shareholders grew 22% YoY to about RMB 61.3 billion, while diluted EPS rose 25% to RMB 6.58, benefiting from share buybacks. Tencent's segment contributions are notable. Value-added services, including domestic and international gaming and social networks, represented about 51% of total revenue. Marketing services constituted 18%. Fintech and business services roughly 30%. Gaming remained the highlight. Domestic revenue surged 24%. International game revenue grew 23%, with hits like Dungeon and Fighter Mobile and Delta Force powering momentum. Marketing services revenue increased 20%, largely thanks to AI enhance ad targeting across Weixin, WeChat, and video platforms. Fintech and business services grew moderately around 5 to 16%, reflecting steady adoption of WeChat Pay and cloud services. On the cash flow and balance sheet front, Tencent generated RMB 47.1 billion free cash flow, although this was down 9% YoY due to aggressive investments. Capital expenditures soared nearly 300% YoY in Q1, reaching RMB 27.5 billion, largely due to GPU and server deployment for AI infrastructure. Net cash position rose to RMB 90.2 billion by quarter end. In terms of valuation and dividend metrics, Tencent trades at a trailing PE of approximately 24 to 25 times, slightly above its recent multi-year average around 18 to 19 times, but below its long-term 10-year average, which is around 27 times. The forward dividend yield is modest, about 0.8%, with a payout ratio in the mid-teens, around 15 to 19%. Combined with buybacks, Tencent's shareholder yield totals around 3%. Tencent continues to roll out its AI strategy at scale. It launched its large language model series, Hunyuan Turbo S, and public version T1, embedding them across Weixin advertising platforms, gaming, and the new Yuanbo AI app. Management expects these moves to compound high-margin revenue streams over time. Leveraging leverage to absorb one-off AI investment costs. Risks and considerations remain. U.S. export controls on advanced chips pose potential headwinds. Though Tencent is relatively well-provisioned with NVIDIA H20 chips, still, broader escalation in trade or regulatory fronts could affect investor sentiment. Regulatory uncertainty in China, especially around gaming, fintech, and data, is also a tail risk, though Tencent has shown resilience and adaptability over prior cycles.
Tencent delivered a robust Q1, combining double-digit revenue and profit growth, expanding margins, solid free cash flow, and bold investment in AI infrastructure. Its entrenched digital ecosystem, centered around Weixin, WeChat, gaming franchises, fintech, and cloud, offers sustained high-margin monetization potential. Valuation remains reasonable relative to long-term history and peers, and shareholder returns, dividends plus buybacks, provide added cushion. For investors bullish on China's digital transformation and AI wave, Tencent represents a core holding, though patience may be required as AI capex impacts near-term free cash flow. Keep an eye on upcoming Q2 earnings, scheduled August 13, 2025, and regulatory developments, which may influence future performance trajectories.